Nama, Isia Zun Nurani. NPM, 23,411,066. Kellis, Manajemen 23x. Bank health refers to the financial and operational condition of a bank that reflects its stability and ability to carry out banking activities. Bank health is one of the crucial aspects in the course financial markets and institutions, as banks play a key role in the financial system of a country. Through the assessment of bank health, regulatory authorities and the public can evaluate whether a bank is in good condition to serve customer needs and support the economy. In the context of bank health, several aspects are used to assess whether a bank is in a healthy condition or not. In general, bank health indicators include aspects such as profitability, asset quality, capital adequacy, risk management, liquidity, and others. A healthy bank is one that can balance the interests of customers, shareholders, and regulators. Bank health indicators. 1. Capital adequacy. Capital adequacy, or capital adequacy ratio, CAR, is an indicator used to assess how much capital a bank has to cover the risks it faces, including credit risk, market risk, and operational risk. CAR shows a bank's ability to absorb potential losses without relying on asset liquidation or third-party funds. A high CAR indicates that a bank has sufficient capital to handle various risks, while a low CAR suggests the bank is vulnerable to potential losses. Bank Indonesia sets a minimum CAR standard of 8%, in line with the Basel Committee on Banking Supervision, BCBS, regulations. However, in Indonesia, many banks have a higher CAR than this minimum to provide a safer buffer against risks. 2. Asset quality. Asset quality refers to the extent to which the bank's assets, especially loans, are subject to default risk. A bank is considered healthy if it has high-quality assets, meaning that the loans extended are of good quality and have a high potential for repayment. Asset quality is typically measured using the non-performing loan, NPL, ratio. If a bank's NPL ratio is low, it means the bank has high-quality assets. An NPL ratio below 5% is generally considered healthy. When a bank's NPL exceeds this threshold, it faces high risk from problematic loans, which can affect profitability and operational sustainability. 3. Management. The management factor in assessing bank health refers to the ability of the bank's management to efficiently run banking operations, implement effective risk policies, and maintain compliance with applicable regulations. Assessments of management include evaluations of several aspects, such as corporate governance, decision-making effectiveness, and compliance with banking regulations. Good management can anticipate emerging risks, maintain good relationships with customers, and sustain optimal operational performance. This factor is very important because, even if a bank has significant capital, poor management can lead to problems. 4. Earnings. Earnings reflect the bank's ability to generate profit from its activities. A healthy bank must be able to consistently generate sufficient profit to remain sustainable over the long term. Indicators used to assess a bank's earnings performance include return on assets, ROA, and return on equity, ROE. ROA, return on assets, measures the bank's ability to generate profits from its total assets. A high ROA indicates that the bank is efficiently using its assets to earn profits. ROE, return on equity, measures the bank's ability to generate profits from its equity capital. A high ROE shows that the bank is managing its equity well, resulting in optimal profits. A healthy bank typically has an ROA above 1% and an ROE above 10%. Stable and sustainable earnings are essential for maintaining long-term bank operations. 5. Liquidity. Liquidity reflects the bank's ability to meet its short-term obligations, particularly in terms of customer fund withdrawals. A healthy bank must have sufficient liquidity to ensure that it can meet these obligations, both under normal conditions and during crises. A common liquidity ratio used to assess a bank's health is the loan-to-deposit ratio, LDR. The LDR shows the ratio between the loans extended by the bank and the funds collected from customers. If this ratio is too high, the bank risks experiencing liquidity problems due to excessive lending compared to its deposits. 6. Sensitivity to market risk. Sensitivity to market risk describes the extent to which the bank is exposed to market fluctuations that can affect its earnings and capital. Banks with high exposure to market risks, such as interest rate changes, exchange rate movements, and commodity price fluctuations, must have effective risk mitigation strategies. To manage market risks, banks need sound risk management policies, including the application of hedging to reduce potential losses from market fluctuations. Banks that fail to manage these risks properly can suffer significant losses due to unexpected market changes. Bank health assessment methods. One of the most commonly used methods for assessing bank health is the CAMELS system, which stands for 6 assessment components: capital adequacy, asset quality, management quality, earnings, liquidity, sensitivity to market risk. The CAMELS method is applied by regulatory authorities, such as the Financial Services Authority, OJK, in Indonesia and the Federal Reserve in the United States, to comprehensively assess a bank's condition. Each component of CAMELS is scored, and the overall score determines the health level of a bank. Banks that receive high CAMELS ratings are considered healthy and able to face the risks they encounter. Conversely, banks with low ratings need to improve various operational aspects to return to a healthy condition. The importance of bank health in the financial system. Bank health has a significant impact on the stability of the financial system and the economy as a whole. Healthy banks can carry out their functions well, such as extending loans to the public, managing savings, and facilitating financial transactions. If many banks are unhealthy, the banking system becomes fragile, which can eventually trigger a financial crisis.